I wanted to take a moment to talk about our sponsor, Alt21, the foreign exchange and hedging platform that reduces the risk and cost of cross-border transactions. As a board member, there are few better feelings than making a suggestion which adds quick material value to your organisation. I remember when one of our board members saved us $50,000 with a quick introduction to a group discount scheme for one of our key suppliers. I continue to feel grateful to this day. Alt21 can offer exactly this kind of quick win for board members. By using their foreign exchange and hedging services, you could reduce your company's costs by 90%. For a company that has just 10 million foreign exchange exposure through its revenues or cost base, that could be over 300,000 back into the business. All21 are so confident that they offer the best value in the market, they show you how much they make from fees in real time before and after any transaction. If you want to save your organisation money on its foreign exchange and hedging, head to alt21.com. That's alt21.com to find out more. Hello and welcome to Enter the Boardroom with Nurole, the podcast exploring what makes great boards and board members. I'm your host, Oliver Cummings, CEO of Nurole, a board search specialist and market leader bringing science to the art of board hiring. Today's guest, Steve Rigby, is co-chief executive of Rigby Group, one of the UK's top 10 wholly owned private companies and among the top 500 global family businesses. Over more than 30 years, he has led the group's strategic growth from £1.5 billion to £3.9 billion in revenue, and from 4,900 to 9,000 employees. He serves on the boards of SCC, Rigby Technology Investments, Regional and City Airports, Rigby Real Estate, Eden Hotel Collection, Nuvius Unified Communications, Cloud Clever, Infinigate and Rigby Group. He chairs the Rigby Foundation, Family Business UK and the UK's Private Business Commission. Steve, a huge welcome and thank you for joining. So, just to start, can I ask you to share 3 pivotal moments in your career that have most shaped your thinking in the boardroom?
So I started life relatively young, being a family business. I also left school at quite a young age. I was slightly a rebel in my teenage years, so found myself in the workplace quite at an early age, being a family business, perhaps given opportunities even too early than perhaps I should have been, but certainly an opportunity quite early on, which was running a retail business we used to own called Byte Computer Superstore. We later sold that to PC World. And, I was running that as a very young man, 23 years of age, running quite a complex business. And it wasn't an easy business. We ended up selling the business, not in a distressed way, but in an environment where we had a pretty brutal competitor in Currys, the owner of PC World. And, we were the underdog. And a consolidation was kind of really always on the card. So that experience, it was 550 people operating at about 60 locations, running almost 365 days a year. It was a pretty tough university experience for me. A slightly different university of life, but so that was really important for me as a journey, and good and bad lessons. Often the second most important phase of my life was actually the global financial crisis, and I learned an awful lot as a businessman during that period of time. As ever in life, you really do learn when things are against the wall. And we, like most businesses, had a particularly difficult period. We had high levels of gearing and covenant breaches happening at that time because trade was incredibly difficult. So when you go through those phases, often when you're doing well, you perhaps celebrate too much your success. But when your business is very challenged, you really get to understand every minute detail. So for me, that experience is right up there in life as one of the most important periods of both understanding business and the downside of business, as well as the upside, and importantly, of how you respond and the need to really strengthen your resolve capability and those around you. And probably the third, is a series of things in my life around disposal. So we've been very lucky not only to build a very large business, which we own today, called FCC, which is one of the biggest businesses in its field in the world, as a reseller of technology, a top 10 player. But also we've built lots of other businesses over the years, and I've gone through a variety of disposal processes that have allowed us, we're just in the process of our third, £100 million plus disposal as we speak. And, those lessons in life as to how you get there, they've all been buy and build processes, assembling management teams, assembling businesses around a coherent strategy. That life experience as to how you can repeat that, we've become much more efficient at how we do that as time's gone on, and I'm sure there's probably a few more in me yet of those type of transactions in life. So really those 3 milestones have kind of represented very important learning stages for me over my career.
Can we go a bit deeper into that first experience you talked about? Because you mentioned good and bad lessons. Curious to hear what those were of going through that extreme competitive market.
Well, in retail, it's one of the toughest businesses. I mean, today it's an incredibly difficult business. There's an awful lot going against you, not least of which the business model's transformed with Amazon and other online partners, and clearly challenges today around national living wage and around national insurance. I mean, really, the retail sector today is in a difficult spot. Back then, it was less about that. It was more about the fact that we were up against very significant competitors. So Currys back in that day was a FTSE 100, run by a guy called Stanley Calmes, who was a kind of legend in his time, ruthlessly run organisation. Would close down people in individual towns and cities with long-term marketing campaigns and pricing campaigns that were, they were, for the day, they were very sophisticated. I'm going back here to business we sold in 1998, so this is quite a long time ago. And whilst we were at the forefront of the internet, we were busy selling Encarta as a CD-ROM because the internet didn't really exist for Google. Google itself formed in 1998. So this was really the early stages of the home PC marketplace that we had. And, as the second largest organisation out there in the UK, we had a very strong position. The business was turning over just a little shy of 100 million when we sold it. So sizable organisation built from scratch. But all of the challenges associated with procurement, frankly, with theft in the retail environment, is a significant concern. Managing a diverse workforce across our own base of superstores, and we had concessions in a business that was around called Office World at the time. So just a very complex organisation to run and set up, which, I learned an awful lot through that process, both good and bad, in terms of my success on even managing people and, being perhaps younger and being a little more aggressive about how I went about that. Today, I'm a little calmer in terms of the way in which I perhaps manage people.
So if someone listening to this today is about to go on to the board of a sort of retail organisation like that, what would be your key North Star bits of advice for them?
Yeah, I think from a retail perspective, people might undermine the complexity of retail, but the supply chain and procurement capabilities in retail are incredibly complex. The store management and employee engagement aspects are complex because it's a diverse, in some situations, non-connected sales force that sits out there and store force. So, if you're managing those businesses, I wouldn't underestimate the complexity that sits behind. Whilst the B2C model of arriving in a store and finding a product on the shelf and taking it home in theory is a simplistic model, the complexity, as you're seeing today in organisations like Asda, is extreme, and very extreme if you're working in the FMCG arena and specifically in food, where clearly the supply chains are very, very complex. So, I think going into a retail business, in my experience of business and all the things that we've done, was by far the most complex area of business I've been in. So my advice is don't underestimate the complexity that lies ahead. So also understanding how banks work, how they provide their own risk analysis is also important. And then you can start to understand where you fit in that matrix. So I would always urge, at a board level, there should be really very senior relationships. Often boards are quite removed from banking, and it's given down to treasurers or to other individuals in the finance function. But I personally think it's a board level responsibility.
So I guess a great question for a board member to be asking is who owns the relationships with our banks, and are those appropriately senior enough in the organisation if they're not the CEO?
Yeah, you don't always need the CEO. It's good to have those, and I'm fortunate to have those in most of the UK banks. But importantly, it's the lead in commercial. It's getting somewhere near credit if you can do. But certainly what you can't do, I really rely on a bank that can read its credit department. So I will stay with somebody if I put through a request for credit and they're prepared to get a credit paper, and it always passes, because that means they understand their own dynamics. So I think it's a case of having the right relationships. Not always the most senior is the one, but I would urge, definitely to have a level of seniority to call upon at times of need.
How are you thinking about the current environment? I was having a discussion with a board member just the other day who's saying most people haven't lived through what we lived in the 70s, where we had interest rates going up at the same time as prices going up, at the same time as assets crashing, and people are blind to this. Curious to see how your thinking is in terms of preparing for that sort of scenario.
It's very difficult to plan for an environment where we sort of lose fiscal control. I can't see that happening easily. We are, though, living in a frightening world right now. So we've got a lot of very angry people around the world, really on every continent almost, and certainly every material region, be it North America, be it Europe, be it the Middle East, India, Pakistan, China, Taiwan. So we've got a really heightened environment. Could we head into a more complicated global war? That's a possibility. And at that point, every bet's off. Aside from that, I think the fiscal disciplines that now exist in our banking system, in our centralized government, federal government, for all intents and purposes, I think we're unlikely to see a level of tail risk that means we have to plan for 20% inflation, 20% interest rates. Frankly, I'm not sure the banking system would survive that today. It is surviving it in Russia and in Turkey and a few other countries, but I'm not sure we want to base any common logic on those type of economies because they're fundamentally dictatorships disguised as democracies. So they have different control mechanisms. So I don't anticipate we'll see that level of 70s tail risk. But could we continue to invest, be in an environment where we have high interest rates? And we seem to have lost complete correlation between asset prices and macroeconomics. I mean, how are we back at the height of the S&P with the level of global conflict happening, trade challenges that we face with Trump? It makes no logical sense. So could there be significant dislocation of share prices? Absolutely. I think that, in the market feels something that should happen. Whether it will, I don't know, because clearly people have vested interests. But it does feel that we're in an environment today where there is dislocation somewhere on the horizon. Certainly, if you look at global bond markets, that feels firmly on the horizon.
Talk to me about the third element you referenced there, which was disposals, and your lessons from that board members listening might learn from.
Yeah, so it's probably unfair to refer the two together, but two businesses both in the same field, both in the distribution of technology. The first one started actually by my father in 92, ran by me from 98 to 2006, and then my brother from 07 to about 10, and I took back over before we disposed of it. So all three family members involved, which is a nice journey. Got to be a large business, but it took us 20 years to get to a disposal, and we had quite a significant amount of assets tied up because it was a business focused around infrastructure, servers and storage and that type of technology. So we post the non-compete the next time around. One shareholder, myself, and a very capable co-founder and a team achieved exactly the same result, same disposal value, same profitability in 7 years with 25% of the equity. So in terms of efficiency of manpower, of financial resources, of time, we managed to get exactly the same result in a much shorter piece of time. So those are just through lessons learned. We didn't go back into infrastructure. We went into software. We internationalized much faster on the journey. We internationalized day one through acquisition. We brought in a capable management team at every level, drove rapid system, integration between the businesses that we acquired, and went about it with a really clear plan. And that's the benefit of experience. And as I say, third time round, we're doing something else at the moment. Can't quite say what, but it's again another good learning experience.
Internationalizing faster is a theme that's come on in past episodes of the Boardroom. We had Nadine Zahawi talk about how it was the making of YouGov, and we had John Allen, the former chair of Tesco, talking about the disaster they had of going into the US. How did you manage that successfully, second, and internationalizing faster? Because often it can be a challenge when you spread your resources too thin, too early.
Yeah, I mean, organic internationalization is very hard in my experience. So we've tried that on a number of levels. And, going about it is both time consuming and inherently risky, will cost you substantial losses along the way. Doesn't mean it can't be done. And certainly if you're a smaller organization, when you're stepping into the US or into Germany or Japan, doing that with a handful of people is relatively low risk in life. It may be risky to your scale of organization, but not a lot can go wrong. But where you're putting material boots on the ground, you need capable systems, processes, logistics capability, supply chain. Then that risk starts to extrapolate if you're trying to do it organically. So typically we use an acquisitive route to do that. It means you buy imperfection, but from that imperfection you can build the organisation that you're looking for. So I think in the UK, if I look at the economy and I look at the straitjacket that we're in right now, I can't see the UK being a high growth environment for quite some years. And therefore, for me, internationalisation, be that through export, if you're an export manufacturing-led business, or be it through multinational or international approach, for me is the way to grow a UK company today. I think if you want to see above GDP growth, you're going to have to probably look outside these shores to achieve that.
And where do you see internationally as being attractive? Because I have heard some people say, well, it's the sort of it's not perfect, but it's better than the alternatives.
I do quite a bit these days in the venture space and varying judges for different awards. And I'm judging some this week for the Private Business Awards. And I get to meet a lot of younger founders. And I love the fact that no one's afraid of the US. So my generation, I'm 52, my father's 82. I think we all were afraid of the US because it was always a fearsome environment. But it depends on the marketplace that you're in. The cost of acquisition today is different than it was previously. So you can enter a new market. If you're a B2C business, it's expensive to go in via Google and Meta, but you can very easily access a market quite seamlessly using a full third-party logistics provider like DHL, and you can be mobile and up and running in a short number of months. So that route into markets is actually just changed radically. So I do see and the US is 9 times the size of the UK, same language. We know it's a different universe of business and the way in which they operate, but I do see the US as the primary landing zone for most people that I talk to. I see Canada as an interesting place, again, for people to do business. We've chosen Western Europe, so our biggest marketplace is France, and we're unusual in that choice. But we've operated, in lots of countries over the years. We're a shareholder today in a business called Infinigate, which is in 28 countries. A major shareholder. I sit on the board. So we're used to operating internationally. Today, I'm intrigued by the Middle East. I think it's starting to get really very interesting traction. And I look at the vision they have. The UAE's 2031 vision is in 8 years to double the economy, be number 1 for safety, be top 10 for health. I mean, they've set some really bold aspirations, top 3 for cybersecurity resilience. So that you've got countries setting these very, very bold aspirations. And I do fear that little old Britain is kind of trickling along, setting quite modest aspirations in the world. So Singapore is interesting, Middle East is interesting, and really you have to have exposure in certain categories in the US.
You've described your journey as being marked by one major inflection point every decade. Can you talk us through a few of those and how you approach them at a board level decision-making perspective?
Yeah, so for the listeners on this, we're second generation. My father founded the business in 75, but really didn't get going in the main trading company until about 79. So been around for 50 years as a group this year. He started mainly in recruitment and ironically had a hostile takeover by 3i and was almost forced out of his own business. But what it did do is it gave him a sum of money to then invest in the PC business. So recruitment was the first inflection point. The second inflection point really was the formation of SCC, which was done through acquisition of, at the time, the sort of largest chain of IBM resellers. The time there were very few PCs being sold. It was the advent of the PC in about 83, 84. In fact, we're their longest serving partner in the UK. That was the next inflection point. Frankly, not got lucky because, he consciously went there, but, got lucky in the fact that the market exploded and the organization went on a rapid trajectory of growth from that point forward. And if I look at the milestones of, the first £100 million, I think was created by 1995. So just a short number of years later, a little over 10 years later, and bear in mind £100 million then is like £250 million today. So, really quite a quick journey to a scaled organization. Inflection point number 3 for us was that distribution business. So, we've gone on to sell to, I have a third, I have a fourth actually as well, but a smaller one. So, we went into a business and repeated. So we learnt our craft, repeated very strongly. The fourth thing probably was the creation of our group structure. So we had businesses outside of the the trading company. My father had some and I had some. We brought those together and we acted as a group structure and allowed ourselves to think about how we allocate assets and how we maximise our rate of return. We set an internal rate of return as our primary goal, which is probably unusual as a primary goal, but it's for us, it's return on net asset as our primary goal. And that allowed us to look quite ruthlessly about asset allocation and how we get the most out of our return. And then more latterly, the sort of final inflection point we've had to date is a sort of final succession journey and a professionalisation of the group to being public company standards, and us running ourselves with a level of external governance that allows us hopefully to avoid making material mistakes. That doesn't mean you can't enter markets that get into difficulty, but you probably need a path to work out how you got there. We continue to make mistakes today, but at least we know why we got there in the first place, rather than that being, I guess, less diligenceable as a process. So we've been on these. We will continue on that journey. So my brother and I, we'll step down as leaders of the business in our mid-60s. That'll be the next inflection point. We'll stay as non-executives, but we'll step down and just have external leadership. And so I think it's important to have milestones to work towards. And one of the beauties of a family business is that we think in a long-term nature.
If you've ever wondered how to better articulate the value you bring to boards, you're not alone. With Nurole Plus, you get expert personalised support. Someone working with you to sharpen your board value proposition, stay current on fast-moving topics like AI, and open doors to more ambitious, higher-profile roles. Head to plus.nurole.com to find out more. You talked there about having return on net assets as one of your guiding or the guiding principle, which is music to my ears from my investor days. What I've found as an operator is that doesn't necessarily motivate your internal stakeholders. Curious to hear how you've positioned that internally to get people internally excited about it.
So we tend not to use it as a measure in the businesses. So we use it at a board level for the controlling company. Each business will have its own measures. So some might be EBITDA related. Often they're going to have cash generation in their goals. LTIPs may be triggered on a sale or on a internal valuation of shares. Some people may be on gross profit. It will really vary we're very diverse. So it will really vary by each business. And the level, in fact, of remuneration depends on the risks in the business. So in our airport business, as an example, the level of short-term remuneration is less than it is in an IT sales organization. And we need there to focus on, making sure we've got long-term safety and risk is factored in. So we will vary the measures across the board. But what we do through the asset allocation is try and make sure that we get the right level of investment deployed to each business to allow us to hit that goal. It's 12% return on net assets after tax. So it's quite a high measure. It's probably heading towards 15, 16% of net assets. Someone like a Goldman Sachs would be at 18% or thereabouts. So it's a high measure. We don't hit it every year, but we blend out over a period of, let's say, a last 3-year period, because disposals of businesses help us along that journey.
You've written in the past about a framework you use, which is, I think, risk, effort, and reward, and as a way to cascade through that thinking through the organisation. Can you bring that to life for me with an example, and perhaps how that ties back to that 12% of taxes?
So we've been looking at risk, effort, reward. We've added in fun to the list as well. So for about 8 years now. So in that situation, let's say we're looking at a startup venture. For us, it would be a buy and build approach rather than just pure startup. But let's say that we've done one recently, which is focused on cloud telephony. So in that situation, we're going out and buying a series of businesses, putting them together with a piece of IP software that sits over them, but having to do the post-merger integration and all the complexity that comes with acquiring those businesses. So in that regard, the risk of that is relatively high. It would be in the sort of medium to high category for us. So we've got to make sure that the reward is, in that situation, also running at a high pace. So no good us setting our 12% rate of return there, because that doesn't warrant the level of risk. So we've got to maybe get 25% internal rate of return on our investment of that business. From an effort point of view, we'll balance that between the team, which have a large amount of effort, and perhaps myself as the board member, and my effort is just a monthly board. So effort for me is low. I've got a chair. Effort for him is medium, and effort for the team is always going to be hopefully high, because we want them all to succeed. And fun, it's a space I enjoy. It's a business I created on paper in lockdown. My kids saw that journey with me because I was talking a lot about it because it was sort of pouring out of me. And it's the one they remember the most. They always ask me how that business is doing. And it's now up and running, and it's 300 people and 35 million of revenue and 3 and a bit million of EBITDA, heading to 10 million EBITDA. So, in that situation, that's high on those areas. Let's say I'm going into bonds. In that environment, my risk is low. My reward is low. I might only expect 4.5%, 5%. My effort's negligible. My fund level's pretty low. But so I'll accept some of that. I'll accept some of the high aspects. And then we blend all those together with that asset allocation to make sure that we've got the right level of risk, effort, reward, and fun in the business.
Do you quantify the risk beyond high, middle, low, or is it as broad as that?
We used to be a bit more scientific, but often these things are you're making up a number. Frankly, how do you know what the risk is of starting a business like that other than high? I think we're just pragmatic. So we just try and make sure that we're not. If you think of a motorway, we don't have everything in the fast lane. We've got some things in the slow, some things in the medium lane, some things in the fast lane. That blends together so that we hit the speed limit collectively. And that's where that 12% ratio comes in, by having different asset classes. So, I'm only ever going to have 5% of my wealth exposed to venture capital, as an example. Today, it's 2%. If I went to 50% there, my level of risk has gone extraordinarily high. Likewise, if I just want to have a bond portfolio, I might get, inflation plus 1% if I'm lucky. And therefore, there's no movement in our wealth. So we try and just balance our approach to look at that level of risk.
It's interesting because one of our past guests, Dan Gardner, who wrote Super Forecasting, How Big Things Get Done, advocates the importance of probabilistic thinking and using sort of Bayesian forecasting. So with something like that, going into a new venture, the base probability of success, if you look over history, is X, and then you adjust from there. And it sounds like you started with that, but then moved to a more intuitive thing, which is the thing I most commonly hear from seasoned, experienced board members. Curious to hear why you think why did you end up with that more intuitive thing rather than the scientific piece, having started there?
So my 35 years in business experience has taught me that spreadsheets lie. So whatever you put down, broadly speaking, will be inaccurate. It's just a degree of inaccuracy, and you can reverse engineer and say whatever you want to say. So had my team wanted to justify that was a medium risk, through lots of comparables of what was happening with other private equity plays happening at the moment, they could have done. As it happens, in that situation, 2 of the private equity plays that would have driven that medium risk are both currently in distress because they over-leveraged. So, that fact pattern has changed, and they will probably judge it as high, which is where my judgment has to come in to say, does my gut tell me that I'm prepared to take that level of risk? Does it warrant the effort required, the allocation of capital? And that, it's one of those very, very difficult things to quantify that not all of us get right. And, I am a fast decision maker. My wife is a very slow decision maker. And so she would want to get 5 out of 5 decisions right. And I'm happy to get 15 out of 20 right. But in my book, I've made 3 times as many. So I'm not afraid of getting some wrong. But I am wanting to put money to work through effective teams and allocation of capital relatively quickly. And that will mean some mistakes along the way. So that's where that gut and experience and wisdom comes in over a period of time. And the more checks and balances you have with good people around you, the more that sort of risk assessment gets more honed.
Interesting. A good example there of what Elena Botelho talked about in episode 125, where she said the 4 characteristics of high-performing CEOs line up with her DARE model, which is decisive, adaptable, reliable, and engaged. And clearly that decisiveness there is a strength of yours. I'm curious, though, to hear about where the fun part of your decision-making matrix came in. Is that something that you can do uniquely because you're a family-owned business, or do you see also a commercial lens to that?
So yeah, the fun part, that's personal, isn't it? So one person's fun is another person's misery. So for me, this is about intellectual stimulation. Some of it's about doing good. So we do a lot of philanthropic work, which I enjoy a great deal. It's more rewarding to give money away than it is to make money. So for fun is a very personal thing. So that should be down to, does somebody love building a business, love building a team? Does somebody love starting from zero and growing forward? Do you love assembling businesses together? I'm a deal junkie. I love the close on the business. I love convincing someone to allow me to buy their life's work. So fun is, it's a really broad spectrum, as it is in anything in life. So, if you're a stamp collector, knock yourself out. If you base jump, do that as well. But, for me, fun is whatever, is important to you. But for me, primarily the two things are intellectual stimulation and the M&A close part. Those are the things I enjoy the most in business. Many things outside of business, but in business, those are the two things I personally enjoy the most. So I try and make sure I interact in the things I can do best at and I enjoy the most at.
Now, you've led over 50 acquisitions.
Yes.
Really interested for board members listening to this, and particularly those in family or founder-led firms. What have been your lessons in making those acquisitions so successfully?
So not all been successful, I would say. So I would say the success ratio is about 70%. But there have been no losses in that period of time. They've just been disappointments. So by losses, I mean businesses that we've had to close down. Except M&A, I mean, the numbers globally are awful. I mean, really, the success ratio is really poor. So you have to go in with your eyes open. I love the fact of continuity of family businesses, the fact that we are held accountable on a long-term basis. So I'm not changing job, every 4 years, and the past is the past, and you can wash away the next, leader's errors in the past. I don't have that luxury, so I've got to live with mine on a long-term basis. I think that helps. From a diligence point of view, we now diligence people, customers, obviously the normal financial, legal aspects. We do a little less on commercial diligence because often we're trying to buy businesses that we already understand. But, diligence in the softer side of life, we think is becoming much more important. Listening to your advisors, and if I look at the mistakes I've made, I've overruled advisors in half of those mistakes. So listening to the advisor, especially the FDD team, the financial diligence team, to make sure that when they see problems, you really listen hard to why they're there and are prepared to pause. I've always been a bit too in a hurry on some of these things. Customer concentration is something that's bit me hard before, so really think hard about that customer referencing and customer concentration issues. So I mean, I suppose those would be my primary lessons out of doing it. And if you've got a good team, stick with the team. I know your board may want you to go out for competitive quotes for everything, but just keep using the same people because you all get a rhythm together, and people build confidence in each other, and people feel more open to talk to each other when they know each other well. So, yeah, my diligence team has been pretty repetitive for at least the last 5 years.
Can you bring to life an example of one where you have overruled an advisor, where you subsequently realised you were wrong to do so, and what someone listening can learn from that?
Yep, I bought a business. I won't say the name of the business. And the founder was Maverick. And he was, through process, I found him intriguing. I found his personality is quite sparkling, but everybody else found him to be someone that was deceitful. And I chose to overrule the financial diligence provider. My team kind of trust that gut of mine, so they kind of let me get away with it on that one. In subsequent deals, when that's come up, they fortunately slowed me down a little. It went on to prove that actually he did have some challenges. I only bought a stake in his business with a path to buying 100%. I ended up selling out the stake back to him at half the price I paid. He then went on to sell the business 2 years later for 8 times the price I paid. So I'd invested in a good business. I just got the character wrong. But his flair ended up being a good flair that did well for him. But, I think you've got to listen to the people around you. You've got to be part of a team. Even if you're the boss, you've got to be part of a team. And I very much these days go on a voting system. So for deals, we really, if there are too many disdainers, we won't proceed forward. And my voice should be, max 1.5 times a normal vote.
Okay, so your lessons from that: slow down and tone down your relative weighting of your voice versus others in the room.
You can, as a chief exec, you know yourself, you can dominate the room if you want to. And if you've got good people around you, you should be. There's a reason they're there around you. So don't have passengers in meetings generally in life, I find. But have meetings with relevant people that you want to listen to. Everybody should be talking in a meeting, and if they're there at an important moment, listen to them all, I would say.
Can we move on to talk about family dynamics? I think, my knowledge, I'm the only person I know whose mother reports to their brother who reports to them, or at least that's the theory. I know that you, your brother, and your father each have your own headquarters and roles. Really curious to hear how the family dynamic has evolved over time and what you've learned about balancing personal and professional relationships.
Well, I mean, as you're experiencing, it's not always an ideal environment working together. It does present its challenges. And, our journey has been no different. We have, though, been very grown up when those challenges have arrived. So, we don't use the word vote very often, but, for us, 2 out of 3 is good enough on decisions. So, if you try and find 27 voices around the table that agree is kind of beyond me. Getting 3 of you to agree on the same thing at the same time in the frequency required is hard. So don't have an environment where everybody has to review on everything. I think is really important. Back yourself out of as many things as you can do, but on the things that matter to you, remain steadfast and firm, and make sure that you're being fair and decent in the way in which you approach things from an information perspective. We are large enough so that we all sort of have our own segments of the business, so makes life a lot easier for us in that regard. Have other voices in the room, so don't have just family. You find that family can have to act more reasonably with each other, with other people in the room, and you can easily drop into a family slinging match. If you're just there with your mother and your brother, whereas if your colleagues are around the table, that's much less likely to happen. And you should be prepared to discuss things openly with in our environment with our board, which is 3 non-family and 3 family. So yeah, I think you've got to be decent and honest. So the most important thing with family is communication. So I chair Family Business UK, so I meet a lot of families. I see so many frustrated generations who have an expectation of what they want, but have never declared it. And I see so many older founders who don't feel as though they've been shown a path on their own journey. And you often have people, same as in marriages, where you get to the point where something is not resolvable because of a lack of communication, frankly, at an early enough stage. So it's always important, I think, to communicate in a non-combative way in as structured an environment as possible. And where's better than that than around a board table, as long as you've got other people with you.
Steve, time has flown, which means it's time for the lightning round, where I'm going to ask you a short question and ask you for a quick response if you're ready.
Yep.
Best book every board member should read, and why?
So 2 books I'd mention. One is Jack, which is Jack Welch's old book from GE, which I just love that book. I mean, perhaps today he's not quite seen as the leader he was then, but biggest company in the world for a period of time and an incredible leader, in my opinion. And then the second one, from a family business point of view, is by a guy called Dennis Jaffray, and it's called Borrow from the Grandchildren. And it just maps out that journey to a 100-year business and how to safely navigate it.
Boardroom behaviour that irritates you most?
People on mobile phones.
Most valuable board ritual?
A good lunch.
Favourite quote?
A man is never lost at sea by Hemingway.
Most significant professional insight?
Never be afraid to knock on the most important doors in life because they often open.
Worst professional advice you ever received?
Oh gosh, it's not personal, it's business. That doesn't mean a lot to anybody, unfortunately. It's always personal.
What have you changed your mind on about boards over time?
What have I changed? The need to have loud voices around me rather than be the loud voice.
When was the last time you got a significant judgment call wrong in the boardroom, and what did you learn?
One acquisition that's gone slightly awry recently. Did we present all of the facts clearly enough to allow ourselves to make a decision? Were we pregnant before the board meeting on actually doing the transaction? Did we allow the board to act as a board? Would probably be the last significant one.
What's the question that you could have asked as a board member that might have surfaced that?
In this situation, it had an over-concentration on the single customer. We should have been more detailed on that point.
How are you better today as a board member than when you started?
Better at listening, more patience.
And finally, 3 things our listeners should take away from this episode. They take nothing else.
We talked a lot about NEDs, but I'll just summarise, the role of a knowledgeable NED that you bring in for a specific task is worth its weight in gold. If you're a family business, the sooner you start your succession journey and the more open-minded you are to advisors and what may feel an alien process, the better, because it's a very well-trodden path. You just need to start the journey along that path. And then the final part probably would be around the construct of the board table to make sure that you have a sufficient number of executives and non-executives. I sometimes struggle. I sit on a couple of boards outside of my group where there are very few executives around the table and it's principally non-executives. I personally like to hear from not just the chief exec and the CFO, but I like to hear from the management structure of the business, even if they're joining the boards as guests. I like to make sure that there are quite a few executive voices around the board table. And often I see that it's just a couple of executives and lots of non-executives.
Steve, as the CEO of a family business, started in recruitment and just done its first acquisition, this has been a particularly inspiring episode for me. So thank you so much for taking the time to share your experience and wisdom.
Thank you very much.
If you're ready to sharpen your board proposition and open up access to more aspirational roles with expert guidance alongside you, Nurole Plus can help. As an Enter the Boardroom listener, you get 10% off. Head to plus.nurole.com and use code ENTER at checkout.